episode of Mortgage Matters. Every Wednesday with Team Adwar. Here's your host, Todd Adwar. All right. We're back Wednesday, 11 a.m., live with Mortgage Matters, cross-country mortgage expert Todd Adwar in the house. How are you doing today, Todd?
I'm doing great, Tim.
I'm excited to hear the market update. I know you start out each show with the market update. I think things are looking up, so I'm excited to hear it.
Yeah, some interesting things came out this week. You know, it's the first week of summer, so happy summer to everybody. So rates actually ticked up a little bit, Tim. The 30-year fixed is back over 7, just slightly, 703. I think the best deal out there, if you're going to look for a 30-year fixed and you're putting less than 20% down as an FHA mortgage, you could get that nationally at 6.48. Nobody seems to be taking the 15-year fix right now, but if you do, it's the average is 6.44, and jumbos came in at 7.25 this week. I think it was 7.37 the week before, so actually slightly down. According to Case-Shiller, the 3-month average of February, March, April of closing prices show that we're growing, but growth is slowing. So let's get into that. A reported gain of 6.3% annually, which was the gain for April, which was very solid. They have a composite, Tim, of the 20 largest cities, which saw a gain of 7.2%, but that was down from 7.5% a month before. And then they have a list of those 20 largest cities. San Diego came in with the highest annual appreciation at 10.3%. New York City came in at 9.4% second. Chicago actually came in at 8.7%. And Portland is still coming in as the lowest appreciating of the 20 cities at 1.7%. We get into a couple of other things I think you'll find interesting. Surprise, surprise, surprise. The Department of Justice is suing another company. They're suing Zillow and the National Association of Realtors. They're claiming that they made an illegal non-commingling deal. And if you're scratching your head, the answer is, yup, who cares? Shrinkflation is the new word of 2023 and 2024. And just like your Doritos and your Oreos and your cookies and your Ritz crackers, well, the typical new home being built is now smaller than it was a year before. So last year, homes were about 2,411 feet. This year, homes are 2,179 feet. Now, if you're asking yourself, you know, what was the record? In 2015, the average home being built was 2,689 square feet. So it's about 20% less currently. We're currently at a 13-year low. The 13 years ago in 11, they were building homes this size. So we've come up and now we're coming back down. And they have to do that, Tim. And the reason why they have to do that is they're trying to keep the houses cheaper with the high rates. And they're trying to make it cheaper because the cost of construction is certainly through the roof. So we're going to have a great show today. We have Micah Smith, and I think she could be introduced as the goddess of the credit industry. And let's bring her on board because she's so knowledgeable in the credit arena.
I love that introduction. Honestly, this is so fabulous. How are you?
We're doing great. Very welcome. Thank you for coming to the show. We're thrilled to have you.
Anytime.
So why don't we start out, if you could tell us how long you've been in the credit repair industry?
It's kind of crazy to even be able to say this, but I'm going on about 11 years now, and it has been quite the ride.
You've seen a lot of what's going on in the industry, and things have changed in the credit community. How did you wind up getting into the credit repair business? I mean, that's not something you to be a credit repair person.
No, I definitely did not dream about going into credit repair at 5 years old or anything like that. So I actually was recruited into this industry. I was working in lending about a little over 12 years ago, and a recruiter called me. And he's like, I've got this great opportunity for you. And I'm not even kidding you, Todd. I hung up on the guy like 4 times. I thought he was the biggest dum-dum I had ever met because I had no background in finance. I didn't understand credit. I'm like, why is this guy calling me? And so finally, after enough persistence on his end, I finally was, I listened to the opportunity. My background is speech communications with an emphasis on TV and radio broadcasting. And so he's like, no. He's like, I like you for the other abilities, your speaking abilities. I was like, okay, that makes more sense. So I listened to his pitch, and then I started up with the firm, which is actually how we met many years ago.
Yeah. It's been many years.
Yeah. So I started with a very big firm out of Colorado, and then I went off on my own about 3.5 years ago. So
which is so great.
Yeah.
So can you start out with explaining the credit scoring system and low to high, what they are these days? Because they've changed over the last few years.
It's still 300 to 850 FICO. So FICO is still the same. It's just that people are seeing different scores from different industries, which that changes the scoring ranges. So you can see all the way up to a 990 with certain algorithms, but FICO is always from 300 to 850. And there's so many misconceptions as far as like what's going on with my score here. Why does it look so different here to here? So it's still 300 to 850.
So when I go onto one of those sites online and then I apply for a mortgage or a car loan, what should I expect as a consumer? Because, I'll constantly hear from clients, oh, my score is this, and then we'll run their credit and it won't be. So what does that mean?
Sure. Yeah. So the different algorithms really throw people into a tizzy because they don't even know that they exist. So say, for instance, Credit Karma. So Credit Karma is one of my favorite examples to give because it's the most popular and it's the most used. So Credit Karma is great. And we love Credit Karma. We never knock it. It's wonderful. They use what's called Vantage 3.0. That's the name of the algorithm or the scoring system that they use to calculate the credit score. And so they're much more lenient in the way that they actually process the data. So, and the interesting thing is so versus say a mortgage person like yourself, as someone who was to go to you and have their scores pulled by you, you're actually using FICO versus Vantage. And FICO, they calculate things very, very differently. So the mortgage world actually uses a series of scoring systems called Beacon 5.0 for Isaac version 2, Classic 04, right? And then you're going to be seeing, obviously, Credit Karma is going to be using the Vantage 3.0. So the discrepancy is usually going to be about 40 to 60 points on average. So usually you'll see Credit Karma about 40 to 60 points higher compared to what you pull. The worst discrepancy we ever saw was a 200-point differential. The client saw a 640 on Credit Karma. The lender pulled a 440. And the biggest thing is again, they calculate the data differently. And they're really only looking at the last 2 years of negative history. So it really is a shortened and an abbreviated version of what a lender is going to take into account when they're trying to mitigate the risk. And of course, give you a loan at a good rate. So it's interesting. And so to even compound on that, so if you go to your credit card company, they use a different algorithm. If you go to your auto loan company, they use a different algorithm. So depending on where you pull it, that's your score with them. So whoever pulls it, like scores are not transferable. Like whoever pulls it, that's it. That's your score.
So would you say that if I see something on Credit Karma and it's a 700 on Credit Karma, I could expect when a mortgage company pulls it that it'll be slightly lower, or depends?
It always depends. So you'll get about 5% of people where their credit score will be higher with you than with Credit Karma. But most people are usually going to see a lower credit score with you than Credit Karma. Yeah, there's no one size fits all in this industry. It's a wackadoo industry.
So let's just say me and my family, we want to buy our first home, and it's now June, and we're thinking we want to buy a home sometime next year, but my credit's not the greatest.
Yeah.
When do I call Micah and say, hey, I got to get my credit score up to, 700? When do I do that? How much advance time before I see a real difference with you?
They should have called me a year ago. Honestly, like I always tell people.
Yeah, but I want to encourage people.
Yeah, of course.
Yeah.
And so it's something where I tell people, I'm like, don't wait to fix your credit until you need it, because it's also not only is it going to help you with the mortgage, right, but it's also going to help you with everything else that you have. Like your car insurance, right? Even your car insurance is going to cost you $150 to $200 more a month if you have bad credit versus good credit. So we tell people start immediately because you can start seeing the savings right away. So we don't want people to wait on that. But if you're geared towards buying a house, which 99.99% of my clients are geared towards buying a home, we recommend give yourself at least a 6 to 12 month buffer. That's really what we want to see from people. We do have anomalies, extreme highs and extreme lows. Like we've had people start at a 500 and get to a 700 in a month. We've had people go from 500 to 700 in a year. So it really is going to depend on what's on the credit report. But, you really want to give yourself that buffer depending on the level of difficulty, that we're going to be faced with when trying to clean up the items on the report.
So, a bunch of years ago after the real estate crash, they went to risk-based pricing based on credit scores, different buckets. Can you explain that, please?
Absolutely. So, really, it's so simple, right? It really comes down to, so I tell people all the time, I'm like, as far as credit score, I always ask people like credit score, like, what is it? Like, what is it for? And people give out like a number of answers. And I'm like, the whole point of having a credit score is to determine your likelihood of default. And so essentially, right, the higher the credit score. So I sit there and I look and study these graphs like all day, like this really boring stuff, but I love it. Like I find it really cool, like probably like you do in the mortgage world, it's like you see this information and you're like, wow. So, but essentially the higher the credit score, the lower your likelihood of default, the less something is going to cost you. And that's really all it comes down to. So the bigger risk that the bank has to take on, the more expensive it's going to cost you to borrow. That's all that it is. So, right, you look risky on paper, it's just going to simply cost you more to really simplify it.
So it used to be that 680 was considered a really good score way back when.
Yeah.
What is considered a really good score now?
So in my world, I really don't want to see anybody below a 760, 780. Like I really don't. And it's just because I know the numbers, they're staggering. They really are. When it comes to everything that we own and purchase, it really is keeping people broke. There's no other way to say it. When we look at what people are paying, so like to give you just like a quick overview. So I pulled this report and let's just say somebody had a $450,000 loan, right? If they were to get a $450,000 loan, and let's say this was, let's say in the state of New York, their monthly payment would roughly equate to around like $3,300 or so before taxes. And that's if they have a 620 to a 640 credit score. And so the total interest that they end up paying over the lifetime of that loan, it's almost about $800,000 over the total. It's a lot. It's a ton of money. But if you jump all the way up to a 760 to 850 to that range, right, then all of a sudden you find yourself in a much lower bracket as far as, percentage that you pay the APR. And then your monthly payment drops down about $500. It goes down to about $2,800. Wow. And then the lifetime saved, like as far as like interest that you pay over the lifetime of the loan, it actually drops like the total interest paid $180,000 over 30 years.
I've never presented it that way. I've never spoken to somebody and said, hey, it's $180,000 cheaper.
Yeah.
Which is this score versus that score. I certainly say, it's $100 cheaper, $300 cheper, your score.
Crazy.
The thing that I hear the most in the mortgage business and the real estate business, the realtors here as well, is I don't want you to run my credit because the score is going to go down. Can you end that wives' tale for
everyone watching? I'd love to. It's one of my favorite ones to end. So hard pulls, right? So hard pulls versus soft pulls. So soft pulls, right? I know that, some companies have the ability to do soft. So if you do soft, there's zero impact to the credit score whatsoever. You can do it 100 times.
You hear that, everybody? Zero impact. When I pull a soft pull, it's zero impact.
Zero impact.
I'm complaining already.
Nothing. Yes, exactly. So you can do it 100 times a day. It's not going to impact the score in a negative way, even if it shows up on the report. So sometimes soft pulls will show up. Doesn't mean it's impacted the score. Right. Versus a hard pull. So a hard pull, people are terrified of hard pulls. Yesterday, the presentation that I did with, this big group of real estate agents, I asked them, like, how many points do you think your score drops when a hard pull is done? And even the real estate agents are like 30 points, 40 points, 50 points. And I'm like, oh my God. I'm like, could you imagine? It's only 2 to 5 points. It's super, super minimal. And the cool thing is, so you know how you probably get blamed a lot, Todd, for dropping the credit score the significant amount?
All the time.
Right.
My score dropped 100 million points because
Yeah.
you ran my credit.
So here's some really interesting.
That you missed your car payment.
Yeah, exactly. Exactly. So here's some really interesting information, right? So it's a 2 to 5 point drop for the inquiry, but the inquiry itself doesn't actually show up until 30 days later. So you're pulling real-time data. The actual inquiry hasn't even impacted them yet. And so that's one other thing for you to be able to bring to the table, be like, no, my inquiry hasn't even impacted you yet, right? The bureaus haven't even had time to report. They haven't even had time to update that information, right? The creditor hasn't had time to give that information to the bureaus yet for that to actually populate into the score. So essentially it takes about 30 days for that to actually impact the score in a negative way. But in your industry, right, there's also a shopping window too. So they can go from lender to lender to lender to lender to lender to lender within 45 days. And it only impacts the score one time. And this can be verified at the CFPB website. So if you just go to, like, in your Google search bar, you put in shopping window mortgage and you put in CFPB, you'll find that information in black and white. 45 days shopping window mortgage, which means, again, their scores drop one time within a 45-day period, 2 to 5 points. The extreme high would be like 7 or 8 points. We don't really see that very often, but 2 to 5 is pretty standard.
So you're saying that if I apply at 5 different companies within a 2 or 3 week period,
yep,
it's going down for the one hit eventually when it reports, but it's not going down 5 times.
Exactly. Bingo.
Okay. But for a credit card, it's different than it is for mortgage company?
Credit card is different. So you're not protected by any laws with the credit card industry. So credit cards, it's going to impact you every time, right? So it's called the dedupe law. And the auto industry also has it as well. So they have a 14-day window as well that protects consumers. So that also can be verified at the CFPB.
Okay. So I have a...
And then can I follow up on that? How long does that stay down?
Yeah.
45 days. When will that bounce back?
That's a great question. So inquiries are most impactful for the first 6 months. So you're really going to see the first 6 months be the most impactful. After a year, they're really worth about a point. FICO actually stops really calculating it into the score after a year. So they fall off after 2. After a year, it really becomes worth nothing. It's still there, but it's not really worth anything after a year.
Very good.
So I have a kid in college. Got 2 more years, and I want to develop credit for him so that when he gets out, he's got this great score and so on and so forth. What's the quickest way to develop credit for my college student?
Absolutely. So the easiest way to help them out is, Dad, just add them as an authorized user to your oldest credit card. And it's one of the easiest ways to help your son or your daughter. I don't think you told me which one it was, son or daughter. So you can help them by just simply adding them to your oldest credit card as an authorized user. All of your history will transfer to their credit report. It only takes usually about 30 to 45 days. So let's say you've got a 25-year-old credit card, you add them to this credit card, they're going to have 25 years of perfect payment history added to their credit reports. Their scores will go through the roof, and then they can go out and apply for whatever it is they want at great rates. But that's literally all that it takes. And again, it takes 30 to 45 days to get.
Do you recommend, how many credit cards should I make him an authorized user on?
So
one or a couple?
So the most that would be helpful is 3. Anything after 3, it really stops doing a lot of positive for the credit. So after 3, like, it's useless. So 3 is enough. So 1 or 2 is fine, but if you want to add up to 3.
So 1 or 2, and then he could apply for his own, and he's got a solid score, or he could get a car loan, so I don't have to buy him his next car.
Exactly.
Okay.
Exactly.
I don't have enough cards for the amount of kids I have in college right now. 3 kids in college. I don't have.
But you can add all of the same children to the same card. So each card usually has a max capacity of anywhere between 3 to 10. So depending on who it is, so you can add each child to the same card. So you should be okay.
Okay. I'll try.
So Micah, lately, because of the prices being so high, we have seen parents, grandparents, aunts, uncles, sisters, brothers co-sign for people.
Yeah.
And they'll always ask the question, well, what's the downside for co-signing on anything? Can you explain that?
Todd, I hate co-signing. Like, I really hate it so much. And I know people do it all of the time, but they do it without the understanding of what it is that they're attaching themselves to. So as a co-borrower and as someone who co-signs, you're 100% responsible for the loan. And I can't tell you how many times, like, I see parents, they co-sign for their children on student loans or car loans, and they just assume their kid's going to pay it off. And then they come to us because their kid hasn't been making their payments and they can't refinance their house because now their kid jacked up their credit score. So just know, if you end up if you end up co-signing for somebody, just know you're 100% responsible for whatever that loan may be. So watch it like a hawk if you decide to co-sign, because there are some good people that you can co-sign for and it's no problem. But just know you are 100% responsible for the loan. It's as though you're taking it out yourself.
So would you recommend that the bill be sent to the co-signer so they can keep an eye on it?
I mean, that's between, the co-signer and the borrower, I mean, if it was me co-signing, yeah, absolutely. Because I would protect my credit score with my life. But if it was me, yes, that's between,
So we talked about authorized users as a way that, mortgage professionals like myself will say, oh, become an authorized user on your wife's account or your mother's account or what have you.
Sure.
What's the downside for the person who makes you an authorized user?
Great question. There really is none. So the only thing is so we always tell people, say Todd, you added your son to your credit card as an authorized user, we just advise don't give them the credit card. So just cut it up and throw it away, because then otherwise you become responsible for that person's spending habits. But otherwise there's no downside. Nothing of your son's will ever impact you. So, I mean, there's really no downside. There's really no risk at all.
Recently, if I remember correctly, over the last couple of years, am I insane to say that medical collections and a lot of the judgments are no longer on the credit reports?
You're not insane at all. Not even a little.
What happened there?
Yeah. So there's actually been quite a few new changes. So judgments and tax liens, this actually happened a little while ago, quite a few years ago, but judgments and tax liens no longer show up on credit reports anymore. So this was a new law that was put into effect quite a few years ago. And so you are correct. They do not show up anymore. So they're still public record. And so, like, say you get a mortgage, title will pull it when they go and they pull public records. And so, but they do not show up anymore. And then medical collections. So medical, this was a result of COVID, and the CFPB stepped in and they said, okay, we've got to do something here, because they just foresaw this being a big, big problem. And so medical collections, new laws are, so if you have a medical collection that was on the credit report, so in July of 2021, what they did was, if you had medical on the credit report and you paid it, the new laws that were put into place was that it had to be removed from the credit report. So before, it used to be, you pay a collection, all it does is it reactivates it and it keeps on the report for 7 years plus after it's been paid. But now it, by law, has to be removed. So that's number one. And the second thing that happened, and this happened in January of 2023. So what they did is they implemented a law that said anything less than $500 would no longer report to your credit report if it was actually classified as medical. So
right, so those co-pays or the whatever, it's not going to be on your credit report.
Exactly. Okay. So you're seeing it a lot less, which is good.
That's great to know. What do you think of the credit monitoring sites?
I love them. I love them so much. Like, I wish that more people had credit monitoring. The amount of people that don't know what's going on with their credit is staggering. And I tell people all the time, you don't have to go out and get a fancy credit monitoring site. You can use the Credit Karma. You can use the free Experian app, and I highly suggest it. And one of the main reasons as to why is 1 in 3 people are going to experience identity theft in their lifetime. So they're really, really good about, like, so if I go apply for something, or let's say a credit balance changes, or if I pay something off, like, the alerts are instantaneous and they let you know right away what's going on. So it's absolutely critical to have something. You need to have a pulse on your credit at all times. Just like you should know what's in your bank account. You should know what your credit score is. You should know what's happening with your credit at all times. And we tell people this all the time, like, they need to have constant credit monitoring. You need to know where you're at.
Is there a company you like better than the others, or are they all basically the same?
So it just depends on how much data you want, right? So myfico.com. In no way are we affiliated. We should be, the amount of exposure I give them. But myfico.com is probably one of my favorites. They are so great. And the reason why we love them so much is they give you access to over 20 different algorithms. So it's a soft pull, of course, right? It's not free. I think it's like 30 or 40 bucks a month, but they will actually give you access to your mortgage scores. It's 100% accurate. And so you can get a fresh pull every single month. They'll give you access to auto loan scores, bank loan scores. So they're really, really good. But again, it's very in depth as far as what you're looking at. My company uses a less expensive service for our internal clients. We use a company called getfitcredit.com. So you can get the bells and whistles if you want to, where it has everything from simulators to monitoring to ID theft protection, to a very basic report but what we love about the reports that we use, or like the MyFICO, is that it's a tri-merge report, which is all three bureaus. So it's going to give you all three bureaus and you're going to see full history. So we're going to look at a full 10-year history with all of our clients. So that way they're not misinformed when they're like, wait, I didn't know that was there, because most of the credit reports that you're looking at.
We hear that all the time. I had a woman screaming yesterday at her husband, the poor guy. What is going on with this? And I was like, maybe you guys should call me.
Yeah, right. I know.
It was 2016, and it showed up. It's funny because it showed up not on the credit report; it showed up on the title report.
Yeah,
we're a week away from closing, and they had a judgment with the state, and turns out they paid it, so their marriage is now safe. But
good. That's good. Yeah, it's crazy. Some of the stuff people just don't even know it's still there.
Well, you've had some real victories, you were telling Tim and I lately.
Yeah.
Clients who have just not only gone through your system, but have gotten houses and cars and met all their needs. Why don't you tell our viewers about that?
Absolutely. Oh my gosh. I have thousands of stories I can tell you, but one of my favorite ones off the top of my head. So I had a young lady that came to me and she was embarrassed because she's pretty successful and COVID did a number on her and her business. And so
Can I interrupt you? So I've had people, the more successful, the more money they make, the less likely they are to pick up the phone because they're embarrassed to say, I made $400,000 and I ruined my credit, or I made $1 million. Don't.
Exactly.
You have the wherewithal to fix it quickly and get back.
Yes.
Exactly. Attitude. Yeah.
Yes. Yeah. Right. And we're trying to avoid that. We don't want people to be embarrassed, because it's like, listen, there's nothing, no risk gained. There's no risk, nothing gained. Right. So she had a rough time during COVID. Her business really just didn't do well. And so she came to me with about a 500 credit score. Now, I'm going to actually give you some more information too. So I'm going to make this educational while at the same time telling you a story. So a huge thing that happened in favor of consumers was, and this is only in the state of New York, and obviously we're in the state of New York, so I want to cover this. But what happened is the statute of limitations changed for New Yorkers. So what that means is so it used to be, so say you defaulted on, say, a credit card, right? Let's say you owed Capital One $500 and you couldn't pay it, so it turned into a collection/charge-off. It used to be that Capital One legally had 6 years to pursue you. So they could sue you, which would turn into that judgment, right? If you didn't show up, it turns into default judgment. So they had this 6-year time frame. Well, in the state of New York, this changed to 3 years.
Oh.
So when she initially came to me, the statute of limitations was 6. And right in the middle of the program, it changed to 3 years. So she had all of these negative items on her credit report, and they were sizable collections and charge-offs from credit card companies. And so all of the debt ended up being forgiven because the statute of limitations had changed. So she had $150,000 worth of charge-offs on her credit report. So legally, they couldn't, right, sue her. They couldn't garnish her wages, anything like that. So now we as a company had a right to go in to try to get this removed from her credit report, because credit reporting is 7 years. So, and we remove things based off of it's not about did you do it? It's how is it reported? Most things are not reported correctly. And the law is very clear about what can and can't be on a credit report. It's also, can they prove it? Can they verify it? So she spent about a year with us in our program. And after a year, she was in the 500s. She went back up to a perfect credit score of over 800, not 850, but she was over an 800 with nothing negative on the credit report. All of the debt had been forgiven. And just in a year's time, every negative item came off of the credit report. And she has literally the world at her fingertips all over again.
Oh, that's
and
great.
she was in tears though, because Todd, she had put together all of this money. She put together about $90,000 to be able to settle all this debt. And I said, I have some news for you. I was like, we don't need to settle this anymore. I'm like, because it's the law states that you no longer owe it. She's like, oh my God, you got to be kidding. So she took all that money and she invested it back into her company. And so I was so happy for her.
That's a great story.
Yeah. So it was amazing. But here's the one thing I will tell everybody. So I was speaking with a client this morning and he's like, hey, I just got this piece of paper and this letter in the mail from the IRS. And the letter in the IRS showed that there was a correction to his income. So he went through the exact same scenario. So these credit cards were forgiven because, again, the statute of limitations changed. So the companies, right, they write it off. They write off the balance. So when you don't pay your credit cards back, they look at that as income. So that does end up so you have to pay taxes on it. So that is the one implication that everyone should be aware of. You will pay taxes on the debt that was forgiven.
I saved $90,000, but the government took a bunch of it.
Yes.
Right.
Yes. You will pay taxes on it.
There's no free lunch. There's no free lunch.
There's no free lunch.
Micah, thank you so much for joining us.
It
was so entertaining. We learned so much.
Absolutely.
And I have to tell you guys, 35 years in the mortgage business, every time I hear her speak, I remember a couple more nuggets to speak to my clients about. So really great. Really terrific.
Thank you, Todd.
We'd love to have you back in the future.
I would love to be back. Thank you so much.
Thank you, Micah. We'll
Thank
see you again soon. All right.
Everybody have a great July 4th holiday, and we'll see you on July 11th.
July 11th, next show. Thank you.